What if there were an AI trained specifically to understand the complex world of finance, an AI that doesn't just spit out generic answers, but actually gets the markets, knows how financial news is written, and can help with economic analysis, investment research, even risk modeling? That's the promise behind Bloomberg. This isn't just another AI language model. It's one trained on a staggering amount of financial data, tuned to answer your toughest economic questions. WRIT reports like a Wall Street analyst, and maybe even suggest trends before the market catches up. But does it really live up to the hype? Let's dive deep into Bloomberg, what it is, how it's built, what makes it different from models like ChatGPT or Claude, and most importantly, how well it actually performs in the real world of finance. First, let's understand what Bloomberg actually is. Developed by Bloomberg in collaboration with top machine learning researchers, this model was trained using a unique dataset, specifically curated financial texts, reports, news stories, SEC filings, earnings call transcripts, and more. Unlike general-purpose models that learn from everything under the sun, Bloomberg focuses on a much narrower but deeper domain: finance. It was trained using a corpus that Bloomberg calls FinPil, which reportedly contains over 700 billion tokens of financial data. This includes everything from economic indicators and press releases to quantitative research notes. And yes, it also includes general language data, so the model doesn't lose fluency in everyday communication. But the emphasis is heavily tilted toward finance. Now here's where things get interesting. While models like GPT-4 or Claude aim to be universal assistants, Bloomberg is designed to act more like a finance-specific analyst. The goal isn't to help you write a poem or draft a sci-fi story, it's to help you understand interest rate movements, corporate filings, earnings statements, risk disclosures, and sector trends. So how do you test something like that? We ran a series of real-world tasks to evaluate Bloomberg. The goal wasn't just to ask basic finance questions, but to simulate how financial analyst, investor, or journalist might actually use it. We tested it against general-purpose models to see where it shines and where it stumbles. Our first test, earnings summary generation. We gave Bloomberg an earnings call transcript from a recent tech company. The request was simple: summarize this earnings call and highlight key financial results. Bloomberg delivered a sharp, accurate summary. It correctly identified the company's EPS, revenue, yield growth, and noted guidance changes. It also detected CEO commentary that hinted at market uncertainty and flagged it. When compared to GPT-4, the difference was clear. GPT-4 produced a coherent summary, but missed a few subtleties like the change in forward-looking statements or note about a supply chain issue mentioned in passing. The BloombergGPT broke down regulatory risks, patent expirations, and pipeline uncertainties. It even flagged a detail in a footnote about legal proceedings that GPT-4 skimmed over. That level of granularity shows how deeply the model is attuned to financial nuance. Then we tried something trickier: financial sentiment analysis. We fed it headlines from various financial news outlets and asked the model to classify each headline as bullish, bearish, or neutral. Here, Bloomberg really stood out. It accurately labeled phrases like beats earnings expectations as bullish, misses revenue target as bearish, and was cautious with more ambiguous headlines. GPT-4 was pretty good, but sometimes overinterpreted sentiment or failed to notice when context flipped the meaning. We moved on to macroeconomic interpretation. Could the model explain complex economic indicators in layman's terms? We gave it a recent jobs report from the Bureau of Labor Statistics and asked for a plain English explanation suitable for an investor briefing. The output, surprisingly smooth. The BloombergGPT described job creation trends, wage inflation, labor participation, and linked it all to potential Fed policy implications. It mentioned rate hike probabilities and even contextualized the data in terms of recent FOMC meeting notes. That the real stress test came when we asked the model to answer open-ended investment questions. For instance, is the semiconductor sector likely to outperform in the next 6 months? Based on current market conditions, that's not a yes or no query. It's the kind of thing analysts debate endlessly. Bloomberg parsed recent industry trends, pointed to supply constraints easing, cited demand from AI chips and automotive use cases, and brought in recent financial results from key players like Nvidia and AMD. It didn't make a prediction per se, but it constructed a logical argument both for and against sector strength. That's impressive. General-purpose models struggled here. GPT-4 provided a good answer, but lacked the depth and specificity. Claude was even more general. Bloomberg was just more grounded in data. So what's under the hood that makes Bloomberg so good at this? It boils down to training data, model tuning, and specialized architecture. The FinPool dataset gives it deep domain expertise. But Bloomberg also applied supervised fine-tuning using financial tasks, things like classification of financial events, summarizing earnings, and parsing tables from earnings statements. This task-specific tuning is what elevates Bloomberg beyond being just a language model. It becomes a financial assistant. Of course, it's not perfect. There were times when the model made assumptions that weren't backed up by the text. In one case, it inferred a bearish outlook from a fairly neutral earnings release. In another, it misread a stock split announcement as a sign of upcoming M&A activity completely off base.